shock Brexit decision by the UK to leave the EU sent waves of uncertainty through the trading markets. But what happens now? What timetable should both the UK and international banks, brokers and institutional clients be working to in order to prepare for the reality of Brexit? What does it mean for the need to comply with MiFID II for UK firms? What is the most plausible regulatory regime that the UK might adopt in a post-Brexit environment? Brexit raises these broad questions, but it also raises specific questions, such as the implications for the double volume cap, systematic internalizers, and more. What should financial institutions do next?
The British public clearly voted in June in its referendum on the main point there being immigration and about the freedom of movement of people. And yet the City of London, its big concern is about the export of services and the use of the European Union passport to be able to conduct business in Europe.
So the UK voted to leave the European Union back in June. Since then we've heard a lot of noise but not much action. What do we expect to happen next?
The media comment, of course, it seems to suggest that nothing will be invoked until end of first quarter next year, maybe April. And even then, once that's invoked, then there's at least a 2 to 3 year period where the negotiation would then take place. So from that perspective, of course, I think there's a whole period of unknown sort of approach, which will necessarily mean that all of the firms will have to adhere to their current plans as though Britain were still in the Eurozone. So yeah, I think from that perspective, you could argue that nothing will change short term for a large part of the city and the financial services firms.
As everyone knows, what markets hate is uncertainty. And we've got this classic, although equity markets have been rising over the last few months on the back of, I think, it doesn't look so bad as it stands today, we still have this huge period of uncertainty. I don't see any way where, when you've got such vital negotiations taking place, that these are going to happen quickly. People aren't going to concede points at the early stage, particularly when they know they have at least 2 to 3 years to be able to negotiate. And that, I think, is a real issue for firms in the city because every firm has to plan its future. Is it going to put an office? If you're a UK-based organisation, do you need to put an office in Europe? Do you not need to be regulated in Europe? These are big costs. And at a time when people are so careful at looking at the cost, what's happened is we're actually putting more costs on the industry.
Now, of course, some of those firms, though, will already have entities in continental Europe already, so there's a question as to whether they will expand those or not. Certainly, over the last few years, London has probably taken even more of the business from continental Europe than was the case in the past. So there probably are skilled people in those areas that could actually then move into those roles, if not a situation whereby some of the continental Europeans who live here in London today may feel that now might be a good time for them to move back home. So, I think the idea that you can't replicate some of those tasks and operations in other areas is not necessarily true.
We always think that this is a UK problem and that all UK companies, in order to do business with Europeans, are now going to have a regulated entity in Europe. But actually what we forget is that many of these businesses in Europe actually have an enormous customer base. A majority of their customer base is actually based in the UK. And they're talking about how they would have to plan to actually put a business into the UK. So we've got all these UK firms looking at regulation and trying to get regulated in the Europe, and all these European firms now looking to try and get regulated in the UK. That cannot be a sensible thing.
I guess one of the key topics in the negotiations is obviously whether UK will get the equivalence decision. And without the equivalence decision, there is no passporting, and before UK firms know whether it's going to be equivalence or not, they don't know whether they have to set up a subsidiary in Europe or not. So I think that's a really key issue.
And I suppose that would be the crux of the matter, really, is that if they were to try and impose things on the city, then there would be a tit for tat in terms of those incoming imports from a UK perspective. Now, there's an issue, of course, somewhat with respect to that, whereby some of those imports now will be that much more expensive because of the fact that the pound has dropped 10% or whatever against the euro since Brexit. So there'll be some implications there, from that perspective.
And one would hope that the currency fluctuations are short-term rather than long-term, depending on what the economic benefits or economic issues of a country particularly are. So you would hope in the end that common sense will prevail.
So what do we think are the most plausible models for the UK's relationship with the EU post-Brexit? People have pointed to Norway, to Switzerland, this EEA model. What do we think is politically feasible?
The British people voted effectively against that. So you would imagine that that particular model isn't one that they could pursue. On the other side, there is the Swiss model, which seems to be almost like a bilateral agreement that you have to have with each individual sort of jurisdiction. That would obviously take even longer to try and put in place, one would imagine. So it would seem as though, to Christer's point earlier on the third country equivalence piece, that if the FCA and the city have effectively either lobbied for or written most of the current regulation that's going to be implemented under MiFID, that you would see that the third country equivalence would be the logical sort of route, whether that's a halfway house or between a Swiss and a Norwegian model, sort of question mark. But I think that's if we're looking at equivalence, then from a global perspective, we also have to understand equivalence of MiFID versus Dodd-Frank. So we shouldn't really then be cherry picking as to where we sort of sit with respect to that. Having said that, of course, if there is an opportunity for that to happen, then the UK may attempt to cherry pick with respect to which bits of MiFID that it would actually like to keep under that equivalence. So what's the definition of equivalence in that world?
We've mentioned MiFID II, and it's certainly dominated people's thinking here in the city for quite some time. Do we think there's any chance that the implementation date, currently 2018, I believe, will be pushed back? Will there be another delay in MiFID II?
I don't think so. We have been working with MiFID II for like 6 years, the industry regulators, and we have passed the level 1 stage. We are now finalizing the level 2, and the list of uncertainties is becoming shorter and shorter. We still see some flaws by the double volume caps and so, but it's very clear that the delay was due to get technology in place rather than discuss more. And so from a clear MiFID standpoint, there is no reason to delay. And I don't think that Brexit will make it more plausible that there will be a delay, because as we said before, that the continental Europe is beginning more impatience about the process. And to set a delay on MiFID II will really mess up things and create even more uncertainty.
So we expect MiFID II to apply to UK firms as far as we can see.
I think equivalence will come in. I think people in the UK will try and push the boundaries as much as they can, but they won't get it. I don't think MiFID will be delayed. I think it would lose all credibility internationally, not just within Europe, if we were to actually change that. So I do believe that January the 1st, 2018, MiFID II will be implemented in Europe.
There's the knock-on effect of equivalence with other jurisdictions outside of Europe. And so therefore, if you don't have a MiFID to comply as an equivalence against the Dodd-Frank, that just obviously kicks the can further down the road from that
Completely agree. It has to come in because you need some form of certainty from an overall European aspect.
And people can't continue to have X number of people that are actually working on the project. There's X amount of pain that's already in there. The costs are already there. At some point in time, there's got to be implementation then, rather than just working towards it. you would imagine actually that most of the firms, to a certain extent, are already adhering to MiFID II prior to it actually being introduced anyway.
Yeah, but you can't tell me the opportunists aren't going to try and take up the opportunity to try and push the boundaries. Of course they'll do that. I mean, it's human nature is that if somebody thinks they can push something and get something extra, they'll do it. And, you know, things like the double volume cap. So I can see people in the UK turning around saying, we don't want them. I can see all sorts of regulation that they can turn around and try and change. In the end, for the very reason we've stated, I don't think they will get away with that, because I think what you're giving away could cost you dear in the long term.
And you know, the good thing at least is that there is some logic in some of the things within MiFID II that actually do make sense.
Yeah, there's a lot of logic in MiFID II. There's some things that are crazy, but there's a lot of logic there.
But doesn't the City of London see Brexit as an opportunity perhaps to push for a lighter touch regime than MiFID II might operate? Things like the double volume caps. I mean, why is that? Would that be appealing to perhaps a lighter version of that?
Even if the double volume caps is only a small part of legislation, everyone talks about it. Everyone talks about the negative effects, and even Marcus Ferber is saying it's not going to work. But the problem is that it's written in stone, more or less, because it's in the level 1 text. And in practice, let's say that UK doesn't implement the double volume caps, and then caps are hit all over Europe, and then dark trading is moving to London, and the UK get an advantage compared to continental Europe. I cannot see that happen in a Brexit situation. So I don't think it's possible to skip double volume caps and still get the equivalence decision. So I think in the end, the equivalence decision is more important for UK than trying to get the lighter regime.
And I think similarly, if you look at the derivative side, you have the implementation of things like organised trading facilities, systematic internalisation actually being applied from a derivative perspective, the large in scale sort of sizes that perhaps are going to be implemented with respect to derivative product, where you have the crazy suggestion that 50 lots is large in scale for a Bund futures contract, for example. So if you had kind of the idea of muddying the water by sort of saying, well, we'll cherry pick certain bits of those and not others, it just generally leads to the idea of regulatory arbitrage. You would imagine that from a general perspective that nobody would want to encourage that. And I think, ultimately, what we should see is more harmonisation across sort of some of those issues, not just here, but also between the US and here, so that it actually makes the freedom of sort of movement in terms of capital market flows actually better. That's really key now in today's world, because while everybody, I suppose, focuses on MiFID, you've got all the other issues with respect to CRD, for liquidity ratios, bank capital adequacy sort of type issues. They're all in a situation whereby they're having to pay huge amounts to meet some of those requirements. They'll have other implications with respect to balance sheet and usage thereof. So I think all of these type of issues, allied with MiFID, kind of suggests that you have to get to a point whereby these things are implemented. There is greater certainty around where we are, so that hopefully in a world where if Brexit then is negotiated to its ultimate end game, that everybody knows where they stand going further forward from that point in time.
I think the majority of people have accepted that MiFID is here, or MiFID II is here, and it's here to stay. I've yet to meet somebody who says, I think everybody thinks the opportunists might try, but everybody I think has also accepted that we basically know what's coming in MiFID II and have to prepare for it.
What about certain specific issues that we've seen in the mainstream press? Much has been made about the possible impact on euro-denominated clearing and how that might move out of the city. Do we think that's real?
I think what you've seen is a natural tendency for continental Europe to want to have something that feeds into European central bank liquidity, and that any euro-denominated contracts which are being cleared within the UK, for example, if they don't have access to that European Central Bank liquidity, then there's a question mark as to whether, in a default scenario, whether that's a fit and proper sort of way to be moving further forward. Perhaps intelligently, the Bank of England now has actually offered some Bank of England liquidity with respect to clearinghouses which are based within continental Europe. So I believe Eurex Clearing, for example, has an agreement with the Bank of England now for certain liquidity sort of pieces on that, particularly with respect to sterling-based products. If we were talking equivalence again, you may argue then that under an equivalence rule that a UK-based clearinghouse perhaps then should have some route into European Central Bank liquidity as part of that. But what shouldn't happen is it shouldn't be a political ball that's kicked around. It should be whatever actually is best for the marketplaces and ensuring liquidity across the spectrum.
But I think the Bank of England allowed access for Eurex prior to Brexit. So, a lot of things have changed from that. If that's then taken away as a result of Brexit, then we're back to stage one again. It would be good to see the ECB open up to the UK clearing capabilities as a sort of as also a gesture of goodwill, which hopefully we'll see in the future.
Another sort of a headline item is the pending merger between Deutsche Börse and London Stock Exchange. Do we see that going ahead?
Well, Brexit's not done it any good. I think they may sell it as a way of, we actually have operations in Germany and we have operations in London, and therefore we're in both places. Personally, I would like to see it go ahead, but I think the issues regarding clearing, the issues regarding data, the issues regarding the impact of vertical model versus a horizontal model have a lot to be answered, and even harder questions to be answered now with Brexit. From what I hear in the market, I think almost everybody thinks that it will now be referred to the second stage of competition. So we're going through the first stage now, so we'll be into a deeper level of competition. And again, I think most people in the market think that the deal will actually not go through in the end.
Again, from a market liquidity perspective going further forward, it would seem to suggest, if we looked at the NYSE deal that Deutsche Börse was attempting to complete a couple of years ago, when that deal didn't actually happen, then effectively ICE came in, did the deal. So from a European derivatives perspective, then actually another chink of sort of the European piece had actually gone to the other side of the pond. You would kind of feel that if this doesn't go ahead and there isn't then this European champion that's there supporting capital markets here, whether you call that UK, continental Europe in a Brexit regime, doesn't really matter, I don't think. One of the issues that I could see going further forward is that then LSE and Deutsche Börse are potentially on the block, and the most likely people that may then actually take them over are likely to be American or perhaps Asian-based entities. So therefore, again, it's sort of, if part of the idea of a Brexit vote, if we go back to that, was the sovereignty sort of type issues and being able to control sort of your own destiny, in effect, you've actually given your capital market space away to another jurisdiction.
Well, as a new competitive exchange, we quite like all this behaviour taking place. It keeps people very busy.
Finally, gentlemen, what would you like to see happen post-Brexit? Start with you.
I think that the most important thing is to get an indication of the equivalence decision for UK. So the whole market knows the odds of that going through, and that should be as early as possible, I think.
Clearly, a passport that was revoked would be very, very hard for the City of London. And clearly, what one would like is to be able to negotiate a deal sooner than the 2 to 3 year period that it's looking like it's going to be.
If we look at it from the perspective that the FCA has probably written a vast majority of the regulation that's actually going to be put in place, so the equivalence piece kind of then goes in line with that perspective. From the perspective of the passporting, We've already seen that a number of UK-based entities have Dublin or Luxembourg-based entities because of passporting issues and the ability to be able to maintain some of those. So I think for me, if I'm looking at it from, again, the good of the markets and liquidity perspective, it's more how the equivalence piece is looked at with respect to more proprietary trading groups. If we see a world where essentially the power of the sell-side firms is going to diminish somewhat, then on one side, the passporting that's been alluded to, if we look at it from an institutional point of view, you want to see buy-side voice actually coming more to the fore, but you also want to ensure that the new liquidity that will hopefully pick up the slack where the sell side is actually not there, doesn't have any issues with respect to being able to act cross-border. And from that perspective, actually that's as much down to how capital adequacy regimes will be viewed and what capital ratios that proprietary trading firms as investment firms will have to have relative to what the jurisdiction is for the investment banks.
It's clear that Brexit does not mean you can ignore MiFID II and any future versions of MiFID regulation. Globalization means that you will still need to be able to interact with investors in different jurisdictions with different regulatory regimes. But with the uncertainty of Brexit fueling volatility and a more complex regulatory environment, you need certainty in your trading and execution technology. Itiviti delivers state-of-the-art technology with a modular and app-based architecture which gives you the flexibility and scalability to adapt to the increasingly complex and challenging marketplace. Itiviti's solutions are constantly evolving based on the deep knowledge of our team of industry and regulatory experts, whether you need execution capability, market and liquidity access, or risk management and compliance solutions. Don't just sit back and continue to rely on legacy technology, hoping it will be able to handle the increasingly complex and risky markets. Make sure you're prepared for the future of a post-Brexit world.